I think like the moniker Fintech is like, I think a popular industry term, but if you really want to understand like how to think about a business, you got to go in what are the products, how do they make revenue, how do they scale that revenue over time, especially in financial services where there might be real capital constraints for how businesses scale.
You're in Figma files. Shout out to all the CFOs in Figma files out there.
I wouldn't say it makes sense to take a pure technology multiple and apply it to Fintech multiples, but there's a lot of nuance here depending on your business model, but also your combination of like how do you deliver a superior product to drive growth and do that in a more efficient manner than financial services companies do.
Don't pull me in a box, bro. Yeah.
Yeah, exactly.
Can you talk about RPO and why that's an important metric?
Not in consumption. It's not important at all. Bookings is completely lagging indicator.
Oh, okay. That was a hitter right there. I didn't expect that.
Expired credits is so small for us that like if we removed that from our calculation, our NRR would not change at all.
At all?
Yeah.
Wow. That's how big the base is.
I don't live that close to the office, and so I'll always tell myself to make myself feel better, and I joke about this with my team. If I'm sitting in a lot of traffic, I'm like, oh, today is gonna be a good consumption day. We actually forecast 10 years.
10 years?
Yeah.
You're forecasting 10 years?
Yeah.
So every number on a page has human consequence. And when you're in healthcare, that human consequence is not just your employees, it's also the providers, the patients, everyone in the ecosystem that you have an impact on and that you touch. I like to think of a really strong finance team as that central nervous system.
Ooh.
It's the only team that is actually able to see the whole picture, to pull together all the disparate sources of information and paint and synthesize the picture of financial health. That Series B, C stage is when that really comes to life.
Is this thing on?
Yesterday's price is not today's price.
All right, folks, this episode is a little different and very special. I recently had the chance to record live on site at Campfire's AI Finance Forward conference in San Francisco. Big thanks to the entire Campfire team and their AI native ERP solution for letting me crash their studio. And for the Twix bar, powered me through. What you're about to hear are 3 mini interviews. They're fast-paced, thoughtful conversations with some of the sharpest finance minds in the room that day. Think of it as a tasting menu of modern CFO thinking. We kick things off with Dan Kang, CFO of Mercury, where we dig into the mechanics of fintech revenue and why not all dollars are created equal. Dan walks us through Mercury's evolution from a single wedge product to a multi-stream revenue machine. He breaks down how he models float revenue in a falling rate environment and makes the case for which types of fintech revenue investors actually care about the most. If you've ever tried to separate quality from quantity in your top line, this one's for you. Next up, Brad Floering, SVP of Finance at Snowflake. He was one of their first finance hires pre-IPO, and he's got the scars and usage-based commitment forecasting models to prove it, baby. We talk about the evolution of Snowflake's commitment-based pricing model, how they comp reps in a consumption-first world, and how they use historical data to better predict the business. If you geek out on metrics, models, and the future of AI and FP&A, Brad brought the goods. And we wrap up with Mitzi Yu from Boulder Care. Mitzi is an early-stage health tech veteran, a nonprofit founder, and one of the rare finance leaders who's held the dual titles of head of finance and head of culture. We talk about finding personal product market fit in your career, how finance can amplify mission-driven work, and what AI means for privacy, regulation, and responsible innovation in healthcare. It's a conversation about values and valuation, exactly the kind that we love here. Thanks again to John Glasgow, the Campfire marketing team, and all the attendees at the conference for making it so special. After a quick word from our sponsors, we'll start with Dan Kang from Mercury. Let's go. A messy or missing cap table might not just slow you down, it could cost you your next fundraising round. VCs get flooded with pitches, and if your equity is confusing or missing, they'll move on fast. Fidelity Private Shares is an all-in-one equity management platform that helps you maintain a clean cap table, an organized data room, and a clear equity story. Schedule a demo at fidelityprivateshares.com, mention Mostly Metrics, and get 20% off. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. This episode of Run the Numbers is brought to you by Mercury, business banking for founders and finance pros who want their financial stack to actually work together. Now, I don't plug tools I don't know or intimately use. I've been a Mercury customer for a couple of years now. In fact, I showed the Mercury dashboard to their CFO, Daniel Kang, from their finance team right before we hit record on this episode. It felt like a full circle moment. And what I love most is that Mercury isn't just banking, it's operational confidence. I can send a wire to a podcast editor, I can check capital balances, and I can approve a payment for a freelancer who helped me with a tech stack report, all without bouncing across tabs or praying a PDF exported correctly. Mercury's making a bet on builders. Whether you're issuing your first invoice or wiring 7 figures for a warehouse build-out, it's banking that scales it with your ambition. Visit mercury.com to apply online in minutes and see why over 200,000, entrepreneurs choose Mercury to run their business finances smarter. Here comes my banking voice. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group, Column NA, Evolve Bank and Trust, members FDIC. The IO card is issued by Patriot Bank, members FDIC, pursuant to a license from MasterCard. Dan, look how far we've come. Beautiful background, beautiful conference. Finance Forward, Campfire, 2025, baby. We made it. We're here in the house. You're the CFO of Mercury. Give us some context here. When did you join and how big was the company?
Yeah, I joined in July 22, so it's been about 3.5 years or so. Joined the company when it was about 300 people. Lots of our revenue, and we really kind of grow from there to be 1,000 people today. I've done a round since then. I've launched a lot of new products and expanded into new markets.
And you were the first finance hire?
That's right. Yeah.
Would you say they hired you too soon or too late?
Very late. It's a delayed job. Very anxious when I first started. I mean, the company was 300 people. I think at my last startup, the company was about 30 people or so when I first joined there as my first finance hire. I think it speaks to the founder, CEO, Imad. This is his 4th startup, so I think he's kind of known the ropes a little bit on the finance side. So he pushed it back, not really knowing what a finance hire does until he hired me. And I think he thinks I add value. We'll see.
You said theirs is very powerful and relatable because I think every finance hire that I've met who comes in as a head of finance, VP of finance, even CFO, they say like, oh, holy shit, what did I just walk into here? And there is that acclimation period. But I think just like a word to all founders, if you're listening out there, think if you want to bring somebody in to help you scale it earlier rather than later. So what was the primary business model when you joined? Because I know you've added products since then, but how did you make money when you first started there?
We started off with a banking account, no monthly fees, no real transaction fees, free wires, etc. And in the early days, we were really making money off of debit interchange. We had a lot of customers who were using their debit cards. And for folks who aren't familiar with interchange, when you're swiping a card at a vendor and that vendor gets settled, call it 98% of the amount. And Mercury earns about 2% that's split across a few different parties.
And I'm a Mercury customer.
Nice.
The account onboarding process, like usually in finance, sometimes having to wait is a friction that's there on purpose. And it's kind of like, is this a feature or a bug? I was approved so fast and I got an account without having to basically like mortgage my house at the same time. I think that was like one of the wedges that you started with, right? Like the speed in which you can onboard a customer.
Yeah. I think a big part of the value prop is how do we get companies up and running? We know founders and early stage finance teams have so many different things that they're juggling, and speed and convenience really goes a long way. And I think the question is, how do we reinvent what that onboarding process looks like in a way that's still very much risk controlled and compliant? So a lot of times people might think, hey, if you are moving quickly, are you sacrificing the compliance side of the house as well? And for us, I think a lot of like the existing workflows, the way that they work at traditional banks and financial firms don't actually necessarily make sense. And there necessarily isn't a risk reason for why they do things the way that they certainly do. So for us, it's really thinking about how do we lean into the areas that really matter from a risk mitigation perspective, but everything else, how do we make it as seamless as possible for our customers?
Yeah, I heard the phrase that founders hate the most is when people say, well, we've always done it that way. And I think in the banking world, there's a lot of processes. It's like, well, why do we do that? Oh, just because we've always done it that way.
Totally.
I think that Mercury is like a really good case study of layering on products over time. Layered on float, interchange, and then SaaS-like features. Take me through the internal playbook for deciding, hey, I think it's time to add the next stream here.
For us, some finance leaders might think it's a little bit backwards, but we actually always start with the customer journey and the product, and we kind of figure out what exactly does a business model kind of look like afterwards. If you think about us, we really started with a free bank account with had free wires, free transactional activity, which was not very common at that
I
time.
didn't realize there's free wires.
Yeah, free wires, international as well. Unless you're doing foreign exchange, then we change a little bit.
Yeah, that's big.
So for us, it's really kind of thinking about how do we kind of follow the customer journey and then making sure there's like a solid economic model behind it. But we never kind of started with how do we make more revenue and where the products are going to help us deliver that, which I've always found leads to like a much better product experience for customers. And that leads to higher retention, leads to a lot of organic growth for us as well if you build with the customer and the product in mind first rather than your business model.
And you're a finance person at a company that has a financial product. Do you feel like you're brought into the room to help kind of workshop some of these things and be a thought partner with them?
Yeah. If we're remote first, a lot of times it's just endless Slack threads, which is kind of the this room nowadays. Yeah. It is actually a lot of fun. I probably spend maybe call it 10 to 20% in any given week, kind of going through product flows. We do this Friday morning thing called an exec product workshop where any exec could sit on it. You don't have to be the engineering lead or the product lead, and different teams will come forward, bring ideas and actually walk through it. I'll get in there into the Figma files and so on to actually provide feedback and comments.
You're in Figma files. Damn Figma files. All right.
Yeah.
Shout out to all the CFOs in Figma files out there. So something me and Ahmad, your founder, have riffed on in the past is the concept of revenue quality in relation to fintech companies. Because contrary to popular belief, I hope I'm not saying something here that people think is apocryphal, but not all fintech revenue is created equal.
Totally.
They all have different gross margin profiles, et cetera. So how do you personally, as a CFO of a fintech company, define quality of revenue?
I think there's a traditional way to think about quality, which is, hey, what gives the highest multiple in the public markets, right? If you think about SaaS companies, they typically have higher multiples than, say, like an on-balance sheet lending that has much lower multiples, right? And I think there's rhyme and reason behind why those multiples exist, right? That I think are probably the things more to focus on versus just the valuation multiples, which I think as finance people, when we're thinking about building enterprise value for companies, it's really easy to get caught up on, hey, what's going to give me the highest valuation? But I think that's a little bit like detracted again from what actually matters to the customers at the end of the day. I think from a business perspective, what we really care about, hey, is this high margin revenue that we could depend on to actually fuel growth, investment back to the product? And then also, is it recurring or is it really kind of lumpy or one-off type of revenue streams are a little bit harder to build like good LTV basis with customers on? For us, I think it's really kind of thinking about the quality of revenue matters when we think about those two dimensions at least. But I mean, something I care about a lot too is given we have probably 10 or so different ways that we monetize customer relationships today, what does that revenue journey look like for customers? And it's going to look different for different companies. So if you take a VC-backed tech starter, for example, they could be a 3-person company, not a whole lot of financial operation complexity, but be sitting on $50 million that's earning revenue for us in the form of treasury fees or in the form of float that we earn on their checking and savings balances. But for an e-commerce company that's fueling all their growth by putting their working capital back into the business. Very different dynamic. In those areas, we're monetizing a lot more so through the lending side of things or through the card spend side of things. And that journey of like, how do customers actually graduate into different products over time? What does that mean for how we think about serving those customers, acquiring those customers, forecasting out their LTV basis? I think that's where I like to spend a little bit more time rather than getting really focused on here's a revenue stream that I'm trying to maximize because it's good for our valuation.
And to play back what I'm hearing, it can be dangerous to just back into what will people give me the most credit for, because not all companies are uniquely suited or qualified to do that. Like if that was the case, everybody would just do annual prepaid enterprise SaaS, right? And then the world would be a pretty boring place to live in. I think you got to work on what you're uniquely qualified to build. And I think what you explained too is you find different ways within the customer journey to double up, triple up, and monetize at multiple points. That's pretty powerful because you end up increasing the LTV of a customer and you've only acquired them once.
I think there's a common metric, right? Net dollar retention that a lot of SaaS companies look at. And for SaaS companies, it's usually by driving increased usage or seats or so on. And in our world, it's really how do we attach on more products over time? And by us starting with the bank account, we're pretty uniquely positioned to start the customer journey with companies when they recently got incorporated, they opened up a bank account before they could hire employees, before they could actually, receive their first investment check and so on. And as they grow into more complicated needs over time, we're there to serve them in a way that feels really organic in terms of how they actually adopt the products.
Yeah, you don't need something super complicated when you haven't even raised your first round of funding yet. So you gotta move over time and mature over time with them. So if you were to think about like what the public market looks at today in terms of revenue multiples, I know we're not trying to back into like, let's create a product for this. It seems like there's payments, there's subscriptions, and then probably towards the bottom, there's kind of like buy now, pay later lending. Like, how do you square what's out there and like what's looked at as most valuable versus maybe not as valuable?
I think in the world of fintech revenue streams, right, I'd probably put at the top, I think SaaS, where you've seen a lot of fintech firms introduce different types of subscription plans as well. Like Mercury's in that camp. There are a lot of other players as well.
Yeah, you added a SaaS product.
Yeah, we did last year, really around our bill pay product, customer voicing products, more solutions that are workflow in nature versus like pure financial services or banking related. And I think this is a common theme that we're seeing as fintech companies look a little bit more like enterprise software companies. It's also interesting to see enterprise software companies that look a little bit more like payments companies over time as well. So at the top, I'd probably still put SaaS in terms of valuation multiples. I think next becomes payments. I think there are a few different flavors of payments. You have the merchant acquiring side, which is more like the Square, Stripe models of the world. And then you have the issuing side, which is more recently kind of Chime and some of these other interchange-driven models. I think they get valued a little bit differently as well. Interchange is set by Visa, MasterCard, Amex. You don't have a ton of flexibility in terms of what your revenue take rates can be. While it's on the acquiring side, depending on what segment that you're going after, there is a little bit more flexibility around discount rates and so on. I would say after that, you kind of get into more so like float revenue, which is a big part of, companies who hold customer balances. In a similar camp, I probably put like AUM fees. So Wolfram recently filed their S1. That probably goes a little bit higher than float revenue, given it has less sensitivity towards rates. If you think about, again, like the predictable nature of the revenue streams. And then I think once you get into lending, there are two flavors of lending. You could do lending where you're originating, but selling it off and you're earning some sort of origination fee from the folks who are purchasing those assets from you. And then you could also hold them on balance sheet, which actually generates more gross profit, but then your ability to scale up is really hampered by your access to capital if you're not a bank and the ability to actually go fund those loans.
Hey, thanks for listening. We'll be right back after a word from our sponsors. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that, but here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit rightrev.com to see how we make complex revenue simple. That's rightrev.com, where revenue recognition actually works. Did you know that around 40% of manually processed invoices contain errors, missing data, bad codes, duplicates? And those mistakes don't just slow your finance team down, they cost you money. That's why global finance automation matters. It's not just about saving time, it's about keeping your business safe from costly errors. And that's exactly what Tipalti does. Tipalti is the serious AP solution for serious business. Tipalti automates the end-to-end payables process, handling everything from onboarding suppliers to global payouts, all so your finance team can breathe again. More than 5,000, of the world's most ambitious businesses already rely on Tipalti to make payments in over 200 countries and 120 currencies. With baked-in security and tax compliance, Tipalti gives you the confidence to scale globally without adding extra finance headcount. Give your finance team their time back. Don't let bad invoices drain good money. Visit Tipalti.com/run the numbers. Tipalti.com/run the numbers. Tipalti, serious AP for serious business. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO of Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. And so I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com, aleph.com/run. Tell them CJ sent you. It's such a fascinating time to talk about it because Chime within the last year and a half, Wealthfront, as you mentioned, Klarna, they're all looked at as fintechs if you just really quickly glance at it, but they're all very different types of fintechs.
Yeah. I think fintech is this interesting moniker to kind of think about it from a product category perspective. If you were to really think about it from a business perspective, though, a payments business looks so different from, again, like an on-balance sheet lender. So I think like the moniker fintech is like, I think a popular industry term, but if you really want to understand like how to think about a business, you got to go in what are the products, how do they make revenue, how do they scale that revenue over time, especially in financial services where there might be real capital constraints for how businesses scale.
And I think you have to look at the gross profit. So I want to zoom in on that. That's what actually pays the bills. Which of Mercury's revenue streams is looked at as the most accretive?
It's interesting. The most accretive for us is float that we earn on customer deposits.
Okay.
At the same time, it also moves up and down and fluctuates depending on what's happening broadly out there in the macro and depending on decisions that the Fed board is actually making around Fed funds rates.
So you're tied to interest rates pretty closely there.
Yeah, there is a tie for sure. But the other revenue streams that we have too, I think you kind of think about the trade-off between margin on a percentage basis versus margin on a dollar basis, right? So we actually...
Say more about that. That's really interesting.
Yeah. So you could actually have revenue streams that are lower margin on a percentage basis. And people automatically think, oh, that's a low quality stream of revenue, right? But if you actually really dig into it, it could actually be a source of pretty big gross profit dollars. And for us, the key is if you could actually grow a book of low margin on a percentage basis revenue streams, but do that with pretty much free acquisition, right? Because again, we're starting with a bank account and attaching things like car products over time. With, car product, we offer 1.5% cashback rate. It's a lower margin product for us, but the acquisition for that is free, and there's a lot of gross profit potential there, especially as companies scale up, they start spending a lot more on Facebook ads or whatever it might be. And the ability to actually attach that on, yes, it's dilutive to our overall gross margin percentage over time, but it generates so much LTV that allows us then like fuel that back into development and growth at the same time.
Okay, now we're cooking. So then how do you weigh the growth element to it? Because not all these product lines will scale the same way. Some of them are net new, some of them attached to existing product lines you have. How do you square up gross profit and growth?
I think it depends on whether you're thinking about your primary wedge products or add-on products over time.
Okay.
I think, and what I mean by that, I don't think this is universally true, but it's at least the way that we think about it. Let's take our banking product, for example. It can be really easy for us to try to grab more market share if we were paying all of our customers 5% interest rates on their accounts, right? I'm sure we would have a ton of people who would want to sign up if we're paying out higher than what they could go get through treasuries and so on. There's a market share play there. Obviously, that would be pretty destructive to our gross profit and our ability to go serve customers if that's the dynamic we were operating on there. I think you kind of have to pick and choose in terms of where do you just like strike that right balance. But if you take a secondary product, for example, it gets a little bit more interesting. You've already acquired that customer. There's already some amount of gross profit base that you probably underwritten onto them. And depending on how competitive of a market it is, like, do you use pricing more as a lever that might hit your gross profit levels, but can help you actually pick up more market share, right? And I think for multi-product companies, that's where it gets interesting, where you have existing existing profit pools. How do you think about existing profit pools potentially subsidizing or taking a smaller take rate on subsequent products that you could actually attach over time? You obviously don't want to give everything away for free as much as possible. So there's a little bit of this optimization equation that also really differs depending on the segments that you're going after. So
What's one assumption you had about fintech revenue that you now think is wrong?
I think it goes back to the earlier point. I think a lot of times people bucket fintech all together, and it gets caught in this weird place as well of, is it a technology company or is it really financial services and branded with lower cost structure because they're digital first, right? And I think the truth is probably honestly somewhere in between, where the revenue streams do look very much like financial services. If you're thinking about payments and float and lending and so on, those are traditional financial like services revenue streams, right? But the way that you deliver those products, the way that you support customers fundamentally looks different, and the type of growth that we're able to drive with a much more customer-friendly product experience also looks materially different as well. So I wouldn't say it makes sense to take a pure technology multiple and apply it to fintech multiples, but there's a lot of nuance here depending on your business model, but also your combination of like, how do you deliver a superior product to drive growth and do that in a more efficient manner than financial services companies do.
Don't put me in a box, bro.
Yeah, exactly.
All right, last one I got for you. What's the best financial decision Mercury has made that the market either doesn't realize yet or appreciate yet?
I think the thing that's always shocking for our board when they first join onto Mercury's board of advisors, or also when we talk to investors, is I think most people are used to thinking about banking and growing market share in banking as kind of a game of pooling different rates, right? So on the lending side, how do you offer cheaper loans? On the deposit side, how do you offer higher yield? And it's a very easy way that like finance professionals, including myself, might make decisions for who they decide to go bank with. I think what people are quite surprised by when you look at Mercury is that we actually don't pay a rate on our checking and savings products. We offer treasury for people who actually really want to go get yield. And it's not because we want to be greedy. It's because we want to have our pricing structure as seamless as possible, so we don't have to nickel and dime you on other things by charging you for every single wire or for every single ACH, the way that it typically works for more commercial accounts. And our ability to grow our deposit base while not offering a really high yield rate is like very counterintuitive for people who are used to looking at banking companies. And again, I think that just speaks volumes to the type of product experience that we're able to offer to our customers.
Dan, well, thank you for demystifying the world of fintech with me today. I appreciate it, man.
Yeah, thanks for doing this.
Brad, thanks for joining me today, man.
Happy to be here.
This is a cool conference, right?
Yeah, no, it's been fun.
I think our panel went okay.
Yeah.
No booze from the audience. So I got Brad here, SVP of Finance at Snowflake, one of the first finance hires there. We just did a panel and we discussed the ins and outs of scaling a company into the billions. What I want to dive into on this podcast with you are some of the nuances around your model. I think Snowflake has been kind of the canonical leader in usage-based in particular. Just to set the scene, when did you join Snowflake and how big was the company?
Yeah, so I joined 2017. So the company was somewhere between 200 and 300 employees. My first year then, 2017, we did 22 million of revenue. So I've seen it scale from 22 to over 4 billion plus now. So that's in the last 8 years.
Snowflake now, big household name, at least amongst us tech nerds.
Yeah.
Was it a sure thing back then when you joined?
No, coming from the financial industry, I have a lot of friends who were investors. They actually talked to me, like when I got the offer, they're like, oh, I don't know, $500 million valuation seems pretty steep. They have a lot to grow into. And so that was kind of the feedback I got from investors. But when I did my diligence, I could really see just from reading like online forums that are, obviously we didn't have that many customers, but the ones that we did, like the people actually using Snowflake, I always described as like they were cultish in their love for the product. And that's what really got me comfortable around the fact that this is really just on the edge of sort of really being explosive.
This wasn't on the call sheet we had. I always find it fascinating when finance leaders are digging in, should I take this job or not? Like, how do you do your due diligence? That just struck me that you were looking at if the customers loved it.
I learned, so before Snowflake, I actually went to I had another operating role at another company called Stitch Labs. And that one, I joined pre-revenue, around 10 employees. We scaled it up to 10 million of ARR, 100 employees. During that process, when we got to like 10 million, you look at their unit economics and you can tell that it was like, hey, we're going to have a really hard time scaling this company from 10 to 100, right? Like the churn is just too great because of the customers that we were handling were just too small. They were kind of small mom and pop shops. They were doing sort of this like supply chain management software business to really kind of help these small retailers that are selling across different, like they have to sell on Amazon, they have their Shopify, they have direct to, like through like outlet stores and all that kind of stuff. And like that was a hard data problem for them. But like at the end of the day, it's so hard, it takes a long time to implement. And that implementation period was very costly from us and for them to see them go out of business after like a year or whatever it was. So the churn was too high. So when I thought about my next job, it was really about like, okay, I feel very comfortable that I can help a company run the operations. The one thing I can't do is I'm not going to go in the code and actually develop the product. So I wanted to find a company that was like, hey, this product is like really good. It's just, they need help on the operations side, which is what ultimately led me to Snowflake.
And how did Snowflake monetize when you first joined?
So we've always been usage-based. Yeah, always. Bob Muglia, who was the CEO at the time, who actually was definitely like he was on the product management side of Microsoft. He definitely had a passion for pricing. And you could see, like, technically we weren't the first ones to offer this sort of model. The actual cloud vendors were the first ones. And so like, as he sort of just thought about, hey, our cost basis is being charged off of this concept of time. Like you're using this compute time, these resources, that's our cost. So why not just charge it from a customer standpoint? And so it obviously has gotten very complicated now in terms of introduction of AI. And like, again, like a lot of customers think about tokens now, which is not time. It's more, like these inputs of like how great, like how big the strings are or whatever it is, the definition of tokens. Like, so we've had to evolve kind of our business model along with that. So it's been an evolution, but we've always been usage-based.
Can you take us through the evolution? Because I've been a Snowflake customer before. I've seen the bills and everything. It's good because usually when it's going up, it means we're growing and making more money. But how has it evolved over time?
The pricing practice in itself first started with kind of this concept of like, hey, we're going to charge like off of like what we're going to charge customers is like credits. Like we're going to give you this credit as an hour of compute time in a smaller warehouse, right? And so that was kind of the start of it. And the pricing principle at that point, we had one product. And so we were charging off of, credits, which was, compute time. There was data storage as well as the data movement. So the data transfer between clouds. Those are the three things that we charge customers on, which is pretty simple when you have one product. And so pricing back in the day was much more of process with the sales team in terms of what kind of discount you were going to offer. So we created discount bands of like, hey, if a customer is willing to commit, X amount of dollars, this is the standard discount that we would give. Anything above that, like one band, we call them bands. Hey, one band below that in terms of a discount, you have to get like a manager's approval. The next level is the CRO. And then to go even further, that seems more like a custom deal. Then you actually get like CEO, CFO involved in those negotiations. So that was like the first start of really pricing at Snowflake in terms of a practice, but then obviously has evolved in terms of as we're introducing more features, more products, now we're not purely charging off of this thing called credits, right? There's other things in terms of like data ingestion. And so we're charging more in terms of, again, not data transfer between clouds, but actually like data movement in there in terms of how much you're moving in. So it's gotten a lot more complicated. And so on the back end, we actually have what's called a consumption table. So the order form is meant to be very simple, right? You're buying one SKU, which is essentially how much capacity you're willing to buy, what you would call like a commitment. What is your commitment to Snowflake? And that references this consumption table. And there's many different tables there in terms of like what it all translates into. Hey, you use this feature, it's 1.3x the standard credit like that you find in table 1A, which is like kind of like where Snowflake started.
Were there any companies out there that Snowflake actually looked at to say we could steal or learn something from how they price it? Because when I think about usage or commitment-based models, like Snowflake's the first one that comes to mind, but I don't know, did you invent it? Was there another company that you looked to?
We had to create a lot of original content. Like just even thinking about like the forecast itself, because I was like, how do you forecast a usage-based model? Like it's not the subscription model. I think the one thing that a lot of people come in and I try to change is their mental sort of construct of thinking about revenue. Like because we're a software company, most people think like, hey, I go close this booking and booking leads to revenue. And in Snowflake, it's complete opposite. Revenue and consumption ultimately drives the booking event itself.
Oh, okay.
And so like the first, like bookings then is the lagging indicator. So you can't really use that as a data point to predict future future revenue. And so how do you ultimately forecast? And so, Twilio they had sort of more of like this hybrid model. It was some part consumption, but their big customers were on these like enterprise level contracts that looked more like subscription. And so I talked to them about how do you forecast revenue? It wasn't going to work for us. And I was like, okay, the only other company out there that I know is the cloud vendors. And so I got in contact with like AWS, talked to their finance team in terms of how do you forecast this revenue. And for us, we were we were new, and every quarter was a new bookings quarter. And for them, they were of such large scale that they ignored all the new customers. Like, oh, that's just upside. That's just greenfield up.
Because they haven't ramped yet.
Yeah, so they spent all their time focused on forecasting existing customers and their usage, but they actually just completely excluded what I thought was the hardest problem, what we deemed as the cold start problem, which is like, how do you forecast a customer that has no historical consumption on your platform? Like, what do you actually predict for them to do? A lot of just original sort of thinking in terms of like how we're going to do this. And yeah, I mean, we definitely made mistakes along the way, but always happy. Like I talked to many different customers now of Snowflake that are also thinking about doing that migration to a consumption model. I'm happy to share with them in terms of like the metrics we looked at when we were a private company versus public company, and like, yeah, that whole thing. The biggest topic is commissions. How do you pay a sales team when you're a consumption model? That is actually a very like hard topic to address. I mean, I can give you sort of our learnings, but I don't think we've necessarily.
Can I ask you about it now? Just TLDR on the commissions. I'm like a dog with a bone. I see it and I'm like, I got to go for it.
No. Yeah, I mean, like, again, because, most salespeople coming in are coming in from a software background.
Yeah.
Right. And so their key metric in terms of their effectiveness or their success or their productivity is defined off of them doing this booking event. This like, hey, I signed this contract with a customer.
Yep.
Now that we're talking about, hey, that's actually just a byproduct of like, hey, the customer is consuming this much. This is how much they're actually just going to buy. Then it's something like, okay, now we have to think about how do I expand within our customer account, not from a booking event, but more just in terms of use cases, like finding workloads within the customer. Like, hey, like finance itself is a customer of like, we use Snowflake internally. And so it's like, that is actually a use case. You could go pursue the finance orgs at your customer to say, hey, have you thought about using Snowflake internally? Well, this is what you can do, and then go win those workloads so that the customer is putting that on and driving compute, which is then ultimately going to drive the booking event. We've always had this, and again, I don't think we've necessarily figured it out. Like one year we had 100% consumption commission. And so you're talking about for reps, they have a real struggle. A booking event occurs and they get paid out on it. Now you're talking about consumption that happens over a period of time. So now it's almost like an annuity stream.
Yeah.
Like that is very different for a sales org to like get their arms around. Not only that, but like a booking event, like, I mean, so much of your comp is going to be set off of necessarily what your quota is. For a booking event, perhaps you can get a customer to lean in, like, hey, we have a lot of future growth here. And so you can get like 2x, 3x your quota. But now on consumption, like, because, I mean, again, we've been working on forecasting consumption for so long, our accuracy is like on a full year basis is plus or minus 5%. So for like a rep, it's like, hey, I got to 110%. Like that is like not great for them because they all think like, hey, I want to be $1 million rep. And are you going to pay a rep $1 million if they've achieved just 110% on consumption? But like realistically, that's probably the best that they're going to do because we're so accurate in our forecasting. There's a lot of very hard things that you have to tackle and like change the culture around sort of like how you think about paying salespeople in a consumption model that a lot of people don't realize until they actually get into it. Yeah.
Do you think reps net like this model better or worse? Like it seems like there's actually more predictability to it, which is actually the reverse of what I thought it would be with the consumption model.
Yeah, I mean, like definitely like when you switch first to like this consumption model, like commission plan, like there is that hit to cash flow, but that only lasts for 1 year, right? And then sort of like once you have that annuity stream, so like there is some first time complaints about like, hey, I really like to be paid off of this booking event, but then once they've gotten past that, they're like, oh, I kind of like this. Yeah, nice, yeah, this annuity stream. Right. I think at the end of the day, like, and I think where like perhaps like AWS has figured out with like this concept of like their consumption, but but you buy for a better discount, you make commitments to them. So like you make this overall commitment, which sets your enterprise discount. Yeah, they call it EDP. And then from there you have to make that commitment, but there's commitments even in there called like RIs or like savings plans purchases, which ultimately reduces. So like, hey, I'm going to commit to using these compute resources for the next 3 years. I'm going to get a discount for that. That's going to go against sort of my EDP discount in itself. But that now you're almost front loading, almost like these like mini booking events. And so they can pay their reps off of those versus we don't have that construct. And so that like gratification of like, hey, I did this thing, I brought in all this cash, I'm going to get paid, is definitely something that sales.
And that's what I was getting at, the instant gratification that like people joke sometimes, oh, sales reps are coin operated. Like some people with that, some don't. I like to think they're more strategic. There is this hurdle they have to get over in their head. Like you're not going to get paid immediately on this.
Yeah. And the other thing is, I mean, like, and I think, Frank Slootman, who was the CEO, and if people have read the book, right, like he's infamous in terms of like, he doesn't want a customer success organization, right? Like
that huge thing, right?
That is the sales organization. And so like, it makes sense in a consumption model because like the booking event isn't the grand event, right? That's not going to drive consumption. What you really need to be doing is finding all these other workloads so you as a salesperson, you have to manage the whole life cycle of your customer. That's how you ultimately drive your conversation. You can't go pass it off. And I think that really works that's really enjoyable for reps that have like a very small sort of patch because they have big customers in there. It's like, hey, if I have a one-to-one relationship, like this customer is a whale, right? And like, that's all I need to do. And I'm managing that relationship. I like the consumption model because of that, because I'm already going to be like talking to them on a daily basis. Like some of our reps already have they have badges to get into the offices of the customers that they're supporting. And so at a high level, sort of enterprise level, they like the consumption model. But for a rep that's like, hey, I have 40 accounts. Like I realistically can't go spend that much time to go find workloads. And so for them, they tend to be more bookings focused, which is why now like we've had a full consumption commission plan to now like, hey, we have different plans for different sets of people in terms of at the highest level, you can be 100% consumption. But then once you go farther down in terms of like reps that have like these large patches, they're going to be probably like 60% based off of consumption and 40% off of bookings, given the fact that they can't manage that day-to-day for finding workloads.
So as a finance person, Brad, this is either going to be an extremely simple question or extremely hard. I don't know. What's the most important variable to get right in forecasting a consumption model?
The way that we do it is based off, it is a time series forecast at the end of the day, right? Historical consumption is the most important data set. And we've looked at a bunch of, and have to, like for what I described as the cold start problem, where you look.
It doesn't even have to be them. It could be someone that looks like.
Exactly. That's what we had to do, right? Like you had to find similarities between a company and perhaps a company that you did have historical data on to go forecast out what they might actually be. Okay. So we looked at like thousands of sort of different data points in terms of what would be the highest correlation. Like one of them was definitely like employee size, right? Like, hey, this is a large, 10,000 plus company. They're going to operate very differently than selling to a company that has 500 employees, right? Just the velocity with which they can do change management and all that is very different. And so you can see these curves, these consumption curves look very different. But at the end of it, and when you're dealing with a consumption model, like every customer truly is unique. Like we've had massive like Fortune 10 companies where they loaded a bunch of data. And so like you saw this huge spike of revenue
sat there
where we all like celebrated and like forecasted out like, oh man, this is going to be great. And then they completely just like stopped loading data. And then they just did these like small like queries just on top of the data. They never refreshed it. And they did that for a year. And it was like, suddenly we over extrapolated really too far.
Yeah.
And then they were buying. So then it was less exciting in terms of like, God, we have to get them to like bring on new workloads. Like we need to get like, this is a Fortune 10 company. Like this could be massive. They're all so unique that like, again, the reason why we had to take it from a data science perspective is we had to develop these like machine learning models that could ultimately build a unique model to each one of these customers.
Can you talk about RPO and why that's an important metric?
Not in consumption. It's not
No?
important at all.
All?
Bookings is completely lagging indicator.
Oh, okay.
So RPO is something that we have to do as part of our regulatory filings, but we get questions all the time in terms of like research, like the analysts, and they're saying, hey, how do I forecast this business? And I'm going to look at RPO, and RPO is not valuable. And
Because it already knows that's at work, so, right? But it is.
yeah, we have to disclose it as part of our filings, and so we put it in there. And some investors will look at it, but it's a terrible way to forecast a consumption model.
That was a hitter right there. I didn't expect that.
Oh.
Okay, so we hit on one misconception. What are some of the common misconceptions about usage or commitment-based models, good or bad?
When you had written a blog post, and I think you put someone you were talking to put an email in there, and you blanked out the name, but it was definitely Snowflake.
I can't confirm or deny, but
I could tell. We've had this evolution of like dealing with like rollover credits, right? Like everything is all in good with the model when it's like, hey, customers are over consuming, and like generally they do, because like they typically buy at their run rate and doesn't really consider growth. And so like when they go make a commitment, chances are that contract is not going to last the end of the life, right? Like customers don't even spend as much time thinking about the end of the contract as much as just the capacity they have itself. Like I feel like end date of a contract is more important for our construct of like definition of a customer for a filing, but like customers care more about these credits, which is
I would always eat it up before the end of the contract.
Yeah. But there are like these cases of like, how do you handle customers that perhaps make this commitment and then they're not using it for whatever reason? Like usually like the most common thing is like they had this champion who like on the data side that was going to implement Snowflake, they bought, and then suddenly that person moved on to a different company, and suddenly like the company is not prepared to go do it. And it's like, what do you do? Right. Like, and I think, so a couple things that I remember on your blog post, and I probably should have read it before this interview, why a consumption model is popular versus a subscription is like, when you look at how you engage with like a sales force and buying seats, like you're making a multi-year commitment on headcount, and you're like, I don't know if I'm going to do that. Right. But you want the discount. And then you go through the implementation period where you're paying for all these seats regardless. So you have this huge sort of wasted amount of money that you're spending on the early part of your contract because you went ahead and bought more seats.
I've done.
And if you do the incremental, right, like they're going to charge you more for that. And so from a subscription model, it's terrible to start versus a consumption model. You don't have that problem, right? Like take however long you want to take in terms of what it takes to ramp up, because you only pay for what you use. And so there's huge economic benefit in the early part of the contract. But now let's talk about, okay, yeah, a customer is, an under-consuming customer. They're running the end of the contract, right? Like this has actually evolved for Snowflake. In our early days, we said, hey, you just had to sign any amount of contract and you would get full rollover. It was very sort of beneficial towards the customer. And so you see customers that like underconsumed, like, hey, I'm going to buy $1,000, and they had like $100,000 of rollover. We actually switched that in terms of like, okay, and where we are now and what that email said in terms of like, you'll actually get rollover based upon what % of your contract you do in terms of like your baseline. So like if you committed 100,000, you already bought 100,000, let's say worst case scenario, you consume none of that. And it's like, hey, I have all these credits. I don't want to buy anything. You're like, okay, if I want 80% of my credits, then I need to buy an $80,000 contract. Now I'm sitting at 180,000.
Right.
And I haven't used it before. And like, that is we hate that. Like we try everything to prevent that, right? Like we forecast revenue in our forecast is shared with the sales organization. So they have early signs of like, hey, this customer is an under-consuming customer. So we can identify under-consuming customers at like month 2 of their contract. We want customers to like, consumption is lined up with the value that they see. And if they're not consuming, then they're not seeing any value, which is just a terrible value proposition. And so we hate this concept of like unused credits or rollover credits. We want them to consume it. And so one, we do this concept of partial rollover. 2, we also allow you to convert those credits into professional services, right? Like what I described in terms of like chances are they bought it with the best intention of using it, but for whatever reason, a technical resource left or whatever, and now they don't have an ability to implement it. And so we'll actually discuss with them before their contract ends of like, hey, you have this $100,000 of credits to go use on our platform. Why don't we convert some part of it? Let's go do like $20,000 of work so that we can provide our resources to make you successful in our product. Because at the end of the day, that's what we care most about. The expired credit or anything that we may recognize in terms of breakage revenue is bad revenue for us. One, we try to do this, but like also at the same time, we want customers to, again, we want this incentive for customers to actually use the product, because we've seen it with so many customers that when they use the product, it's really great and they see a lot of value. So we don't want to do this kind of like full rollover. At the same time, on our cost side, in terms of what we talked about for savings plans and RIs, we're making commitments on our side to lower our costs. And so in our forecast, we have an understanding of where we think we're going to go. And so we've made also commitments, 3-year commitments on our side to go, essentially buy that compute for that customer. Now, we have the advantage of the fact that we're over 10,000 customers. So at the aggregate level, it probably all works out, versus an individual customer might seem like highly penalizing. So we do have that aspect. And then net revenue retention rate, I think you also addressed in there, like that is not boosting or juicing any part of our net revenue retention rate. Like expired credits is so small for us that like if we removed that from our calculation, our NRR would not change at all.
At all.
Yeah.
Wow. That's how big the base is. I think what underlies all of this is the idea of where risk sits in the relationship, because usage based, if it's pure usage based, it's like, well, if I get out of the taxi cab, that's fine, I only went to Midtown. But if you get in the taxi cab and if you get out of Midtown, you still get charged for going to Hoboken, it's a little bit different.
Yeah.
And so it's kind of like which side is more or less protected. And what you said earlier, to the individual customers, it may feel overly penalized. And it's not just Snowflake's model. It's really any model that mimics this.
Yeah. We try and introduce as many mechanics or mechanisms so that they actually get value, because again, we want them on the platform.
And use it elsewhere. And you also have a whole app ecosystem, but you have a whole marketplace where you can buy anything under the sun at this point.
Yeah. Yeah, no, it's great. I mean, we actually use Marketplace we actually use or ingest data on holidays, like local holidays, because that's part of one of our factors in our revenue forecasting. So like,
this is a quirky seasonality piece. Can you touch on this?
There's tons of seasonality and consumption-based model, because I mean, at the end of the day, we're dependent upon customers using our platform. And so if you think about just like a week, for our customers, their employees are in the office Monday through Friday.
Yeah.
And so we'll see more consumption on those days than perhaps the weekend. And so when you think about in a more sort of manual way of forecasting, when you're predicting out a month, you might count how many weekdays there are.
Yep.
And then you might actually
22.5 in certain months, 23.4 in others.
And then you might start calculating holidays like as well. Like, hey, this is 4th of July. That's actually going to look more like weekday consumption. And so like, obviously we've built this, very sophisticated machine learning models to ultimately forecast customers. And one of the things that we ingest from the marketplace is local holidays, because we have 10,000 customers that are around the globe. And so we can say, okay, this customer has a ship to address in Japan. This month is actually Golden Week. And so it will look at that customer or customers in Japan for the last 2 years. And again, we're getting that data from the marketplace to tell us when Golden Week was for the past 2 years. And we can actually see the week over week change that occurred in customers in Japan. So now for this customer that has a ship to in Japan, we're going to predict, okay, this week they're going to be down 10% week over week because their employees actually aren't in the office running queries.
That's so interesting. I'm guessing when there are Christmas breaks and people are in the office in between Christmas and New Year's, it's probably like the opposite of certain companies when sales are going up, right?
Yeah. It's Q4 I always describe as like my worst quarter, because like I get a lot of anxiety in terms of like predicting revenue correctly. And like our historical data was kind of messed up from COVID because our customers, the employees, were basically just working all the time. And so you didn't have as much of a seasonality. Like at the end of the day, Snowflake, given its size, is almost like a measure of employee productivity at this point. Like,
wow,
I don't live that close to the office. And so I'll always tell myself to make myself feel better. And I joke about this with my team. If I'm sitting in a lot of traffic, I'm like, oh, today is going to be a good consumption day. Q4 is extremely painful because there's not a lot of insight I can gather in terms of what customers are actually doing on the platform, because you have such a long period of time and you don't really like, depending upon what day Christmas falls, it can actually have a massive impact.
Christmas on a Wednesday. I remember Wednesday's worst case scenario because people don't work Monday, Tuesday, or Thursday, Friday. Yeah. But if it's on a Friday, then you still have the first half of the week.
Yeah, exactly. So like you have to consider that in like when you're creating, and we actually forecast 10 years.
10 years?
Yeah.
You're forecasting 10 years?
Yeah.
That's crazy. Okay, so gearing towards a close, I want to ask what excites you the most about forecasting tools.
Obviously, we've created our own system. We are leveraging machine learning models that are part of like open source libraries, right? Like, and we are catering, like we're taking those and catering them for ourselves for most of them. We have a series of models. But like what's really amazing now, like initially we were doing all these models and running them locally on a computer, right? Like getting from Snowflake, all of consumption data. Now we actually execute all of that Python because all of our models are written in Python. We actually execute that in Snowflake. And so now overnight we run the data pipelines of understanding what happened yesterday in terms of consumption. So it's looking at how many credits were consumed. It's pulling in Salesforce data in terms of like what is the price of their credit, like the discount and all that stuff, to determine to get revenue. All those data pipelines run overnight. And then in the very early hours of the morning, the forecast model itself runs. And so it's all automated. Every single day, we have a reforecast of our revenue that we then view in a dashboard. And
Every day?
yeah. And we compare it against plan.
You get to revenue on a daily basis.
Yeah. I can see what yesterday's consumption was, and I get that. What the real forecast is. And we actually forecast by customer at a daily granularity. So every single customer for the next 2 years using the machine learning models, and then we have another series to forecast the next 2 to 10.
Wow.
But we have this like amazing rich data set that tells us, hey, we think this customer is going to consume X amount of dollars on this day. And that's the information, again, that we share with the sales organization. So it helps them manage their customer in terms of, hey, is the customer on path to actually consume their contract?
Brad, this has been a blast getting to hang out with you today. Thanks for taking us into the business model.
Thank you so much.
Mitzi, thank you for joining me today.
Thank you for having me, CJ.
Not a bad backdrop, right?
So beautiful.
I was laughing earlier because I quite literally started this podcast from my parents' basement. Now I have I think that's the Bay Bridge. I said earlier Golden Gate, and that was definitely not the Golden Gate Bridge over there.
It shows that you're not from the area, but yes, it's a beautiful day. San Francisco. Look how far you've come from your
Started
kitchen.
from the bottom, now we're here. Let's start out. Tell us a bit about your current company and what it does.
I am currently the SVP of Finance, head of finance at a company called Boulder Care. Boulder Care is a telehealth company. We deliver life-saving services in the substance abuse disorder and addiction care space. And so we are currently serving about 20,000 patients. It's been an awesome journey so far.
20,000 patients. That's a lot. So how does finance enable that mission?
So finance in so many ways has so many things to do. So you can imagine with a telehealth business, number one, the nuances of being in the Medicaid space itself and needing to find sustainable margins, being able to have like a business model that not only works. So it is by no means an accident that we are a healthcare services business in the Medicaid space, and we're delivering software level gross margins at being able to really capture the value of what we deliver to our patients and move towards like a value-based care. And so a lot of it has to do with the understanding of what is our strategy? How do we maximize our unit economics? But also, how do we support that? And how do we support that growth in the most responsible way possible, where we are being really thoughtful and judicious about all of the costs to make sure every dollar is doing all of the things.
So you've been in the health tech space, maybe that's not the right phrase for it, but call it the health tech space for a while. What are some of the inflection points that really changed the industry and made it tech enabled?
So let's rewind. I was very much fortunate in my career. I started in healthcare investment banking, but was at the right place at the right time. So my director and I, we actually started the healthcare technology, digital health, investment banking client list from the ground up in the early 2010s at JP Morgan. And it was just a fun time. And you can imagine in the early 2010s, the word of the day was disrupt. Everyone was trying to disrupt every industry. And this was really before Uber was still a black car service. Netflix was still shipping out DVDs. And then there was this idea that technology, being as pervasive and ubiquitous as it is, could really permeate and make a difference in healthcare. So I think it's been such an interesting evolution of where the industry has come to and from. So I would say in the world of inflection points, obviously the pandemic was like the biggest one. The pandemic and the forced adoption of needing to have a virtual element to care. Keep in mind, telemedicine in general was kind of like this. We are not even sure that the majority of people will actually substitute meeting their doctor.
Because it was around before COVID, but it wasn't forced or necessary.
Exactly. So the adoption of it, the widespread adoption, and just the familiarity of telemedicine being a front door to accessible care was such a huge difference. And now I think we're entering a very different, fun stage where we are also in the AI industry of trying to understand how AI fits into healthcare. There's so much thoughtfulness at our company about how we layer in AI to really enhance how we deliver care, all those different pieces. So telemedicine, healthcare technology, it's been a wonderful journey. I've been fortunate enough to kind of be in this world for about 15 years. And I have to say, like, this time I have never been more excited to be in the industry.
Because if you look at the industry patterns of other tech realms, like you brought up Uber earlier, we went from the desktop era to the mobile era where Uber wasn't possible before to get a cab from your phone to now the AI era where everything's changing. It seems to be all these kind of eras of growth within the health tech space as well.
Yeah. It's so much of it is driven by the macro necessity of what's happening and the overall, for example, the AI industry right now. Of course, the healthcare industry would benefit so much from AI enablement. There's so much in the world of healthcare that is just nonsensical admin and
totally, yeah.
just barriers and red tape. And so it's just this industry, I think, that is going to be really impacted. And I have a lot of optimism for it.
I love the optimism. I do want to go back a bit. So before Boulder, you worked at a public company where you held, I think I have this right, the dual roles of head of finance and head of culture and employee experience. Those are two titles. It's not like peanut butter and jelly. It's like oil and vinegar or whatever the saying is. So that's not a combo we usually see. Can you break that down?
Yes, I had the wonderful experience at a public company, head of finance and head of culture and employee experience. I was very fortunate for that experience really early in my career to be able to be the finance leader that I am today. And you said something interesting of like, it's not peanut butter and jelly, it's oil and vinegar, but it actually is peanut butter and jelly. So if you think about it, the success, one of the most egregious mistakes a finance person can make is underestimating the success of the human interactions and the employee base and how that drives company success. For me, the experience itself, which was granted unique, I don't think most head of finance people are.
Because you were finance first, right?
Finance first, and then voluntold to be the head of culture at the same time. So I am very grateful for that experience. I know it's very unique, and it is the cornerstone to how I bring finance leadership into every company, that every number on a page has human consequence. And when you have to own both sides of the equation, it's a very different muscle in decision making, but it was interesting.
It probably impacts how you think about allocating resources.
100%. And so every number on a page has human consequence. And when you were in healthcare, that human consequence is not just your employees, it's also the providers, the patients, everyone in the ecosystem that you have an impact on and that you touched. And so when you take that philosophy of every number on a page has human consequence and you magnify that by the impact, it's just a very interesting way of thinking through. It's, again, this is a healthcare services business at Boulder, meaning our providers and our clinicians, they're the ones that are generating revenue. It's their services that they're providing, they're generating revenue. So we have real humans generating real revenue. And at the same time, all of that is this virtuous cycle in the world of metrics and what counts. It's not just about the financial metrics, right? It's like, how do we deliver the best possible patient outcomes? And the better outcomes that we have, the better metrics that we have, the more fortuitous it or the more virtuous it is for us to get better contracts. And then that impacts our finances. And then all of that comes together in just a very thoughtful circle that it all kind of fits together.
I've often said that it's so important to get the people element right because 70% of our costs walk on two legs. But I never thought about it in your case. It's also the patients, the clinicians, the whole ecosystem is built around those people. So you have to take that into consideration.
Yeah. So now you see why it's peanut butter and jelly.
Yeah, all right, I'll buy it. You seem to have found your personal product market fit in this Series B, Series C scale-up stage.
Mm-hmm.
Tell me a bit why you like that kind of zone to work in and what it means to you?
It's such a fun place. Not that I don't enjoy building, but I did come from the public company first, and then I have a portfolio of seed stage companies that I also advise, and it's super, super fun in different ways. I find so much joy in being at this stage company. This is like when it's time to grow up, when finance becomes more than a back office function where the lights are on, the bills are paid, and now it becomes a strategic lever. And so now you can incorporate finance into decision making and data and all of those different pieces. So that's like that really fun inflection point where it's time to grow up. And it's a combination of what are the new systems that we're going to implement. I am often blessed with the fun task of moving off of QuickBooks. And so,
You've done it multiple times.
and so it's just this like, what are the ways that we are going to be growing up? What are the components of scale that are really going to make us successful from an operational perspective in finance? And then what are the ways that finance can be so strategic in the company going forward? I have a cheesy metaphor that I love using, which is if you think of a company as a living, breathing organism. So at Boulder, our clinical team, they're the heart, sales and marketing, the voice, operations, the muscle. I like to think of a really strong finance team as that central nervous system.
Ooh.
It's the only team that is actually able to see the whole picture, to pull together all the disparate sources of information and paint and synthesize the picture of financial health. It's also one of the key teams that's able to help all of the other vital organs and body parts work together so that we're all moving in the same direction. And I think that Series B, C stage is when that really comes to life.
You start to connect all the dots between
Exactly.
people building it, people selling it, and the people helping those two groups do it better.
Mm-hmm, mm-hmm.
I was CFO at a Series B, became Series C startup. We ended up selling it. We had an exit. And I remember somebody saying to me, "Oh, CJ, now you get to level up and go play the next game. Like you could go and be a CFO to Series D company or like try to get on the pre-IPO path." And then I thought to myself, well, what if I like this stage the most? What advice would you have to people who found their kind of personal product market fit at one stage, but they also have like this pull, and I don't know if it's just from the world we live in, to go bigger and bigger and bigger.
Yeah, yeah. And isn't that just like human condition to always want like bigger and bigger?
Level up.
I don't know. I think it's obviously like a combination of your personal desires. Everyone is this mosaic of different things in their life that matter. And maybe like at certain points, family is, I have 2 young boys. So family life for me is it's a very specifically necessary thing that I dedicate non-negotiables towards. And that will change as the boys grow older and become teenagers who don't want anything to do with me. And then I could probably do something else with my career. So I think it's a combination. I wouldn't presume to give anyone advice on how to think about the different stages of where they want to be in their career or what kinds of companies they want to be at. But I think the only thing I would say is it's a composite of all the things that matter to you, and that will always change. And so something that's right for you at this stage in your life is going to be different. Right now in this stage of my life, I freaking love this moment. I freaking love the things that I'm able to do. Am I going to be doing this forever? Am I going to be doing Series C forever? Who knows?
I had spoken to Vanna Krantz, who is the CFO at Disney Plus, and she said, well, I was kind of finding what worked for my life at different periods. And you don't have to always think about it as this chapter is the end chapter in the book. It's just a chapter.
Exactly.
So you're involved in a number of nonprofits, right?
I am.
And you've started a couple?
I have founded 3 nonprofit organizations, yes.
So the job wasn't enough. You had a 25th hour in the day. Give us a take on one of the nonprofits that you're working on right now. What does it do?
Well, it's so interesting because, and I'm going to cheat and I'm going to give like a take on all 3 of them.
Okay.
All 3 of them, I think, were just moments in my life where I am so fortunate to be in an industry that I feel is making a tremendous impact in human lives and is doing a service to humanity. In the world of healthcare, especially in the world of healthcare technology, building innovation into that has that element that is so fulfilling. And I think a lot of folks in the industry gravitate towards that mission-driven connection to your job, your purpose, and how that creates, a ripple effect of good. And I have a lot of other things that I care about beyond the healthcare technology realm. So the nonprofits that I founded are really a reflection of things that have mattered at different moments in time. For a while, I was the only non-white, non-male person on the healthcare investment banking investment banking team. Part of that experience was the need to create community. And I remember being internally involved with a lot of different women's groups within the investment bank. And I kind of wanted to just extend that outside. So my first nonprofit organization was about how to create mentorships between working professional mentors, working professional women, and undergraduate students, and really starting that community and connection very early on in a way that I had to build that while I was already a working professional. I had to create that sense of mentorship with the seniors that were available and willing to take me in as a mentee. My second nonprofit was at a moment where I was pregnant with my first son and was exposed to the deep inequities of maternal health care. And so my second nonprofit was about how do you bring prenatal wellness resources and make that equitable. And we launched it here in San Francisco. And then my third nonprofit organization was in 2021, in a moment that I think we as a society and as a moment was really being awoken to the need for diverse representation. And so my third nonprofit, Anti-Racism Books for Children, ABC, we've donated about 4,000 classrooms and positive, diverse representation, characters of different backgrounds, with the need for, number one, for folks to see themselves represented, and number two, for you be exposed to other perspectives that are outside of your own.
So what's your philosophy on business and the intersection of doing good? Can a company have a cause and also thrive from like a durable revenue perspective? Like, how do you wrap your mind around that?
Oh, yes. That's why I love the company that I'm at right now. Boulder is, I think that intersection, first of all, that intersection is much less common than is available, and I
feel like it's not widely available.
It isn't, and I think that it's a very delicate balance. And so here at Boulder, we have such a deep connection to the mission, the work that we're doing, the world of substance abuse. And I think, unfortunately, is so pervasive in our country that so many of us have a direct connection to it. So we all feel very personally connected. And as I mentioned, how amazing to be delivering on the kind of outcomes that are industry leading for 20,000 patients right now, and we're growing, we just grew 3x. We're right now giving that amount of life-saving care to 20,000 patients. And by the way, we're also doing it in a crazy, great unit economics situation, software level margins, as I mentioned, in a value-based care world. So it can all come together, but those are much fewer instances, then it's very rare and very special.
It's hard to find, but once you have it, like you said, it's amazing.
Yes, it's like, that's real peanut butter.
Yeah, that's real peanut butter and jelly. Tell me a bit about how you are using AI today, how you're thinking AI may change your industry. Health tech is like its own can of worms between the co-pays, the regulations, the privacy laws. Like, I feel like you're playing on hard mode, honestly.
Yeah, it's like we like to do everything in the most difficult way. I am so bullish on AI in not only the healthcare industry, but very specifically in finance too. What I think is a fundamental need for a company to develop very early on is, if you are going to be adopting AI, what is the overarching core philosophy? What are the applications of it? And how do you think through decision framework? So at Boulder, we were very, very thoughtful very early on. One of the core mission statements of our AI strategy is AI at Boulder is not meant to replace humans. AI at Boulder is meant to enable more human connections.
That's good.
And so that becomes our cornerstone philosophy. Then it cascades into, well, what are the different applications of AI? Well, we have AI applications for our patients, AI applications for our clinicians, and AI applications for operations and internal efficiency. That's the world that I think I live the most in as a finance person. So as we thought about how do you bring AI into your company in a thoughtful way, and granted, I think a lot of people we're seeing it all over the news right now. I think a lot of people made rushed decisions without fully understanding the impact. And now the workforce that was replaced and where they were realizing, oh yeah, actually like humans are still important. That's one thing on the finance team, for example. I cannot replace judgment. That is not something that I ever want to replace in my team. However, does my team need to be doing all the different reconciliations and the little things that take up so much of their time? Probably not. And so again, with this thesis of AI is meant to enable our humans is so fundamental in our finance strategy. We are implementing our AI ERP, that's why we're here. We're also being really thoughtful about where does AI sit in the many, many myriad of things that are so inefficient about healthcare billing, revenue cycle management, the act of billing and collecting claims and all of that and working with the payers. That is such a manual, repetitive process that is ripe for automation. Again, I have an incredible RCM team. I'm not trying to replace them by any means, but I want them to work smarter, and I want their judgment as the thoughtful people behind solving some of those claims issues. I want that to be their primary focus, and I want AI to take over all the things that they don't need to be doing.
The billing piece just hit me. So I grew up with a father who owned a physical therapy business, and he would walk me through how he would get a certain dollar amount per patient from one healthcare provider, a certain number from another, and they all had different payment terms too. And then the collection process with the patients too was completely backwards. And that's kind of at the intersection of AI, the industry, and finance where we can help.
There are a lot of really awesome companies right now that are solving this, which actually brings me to another core tenet of our AI philosophy, which is the distinction and the understanding of when to build versus buy.
Ooh, go into that.
There is no reason why Boulder, as a substance abuse telehealth company, needs to figure out how to do AI denials billing. Like, that is not going to be
Or build a CRM internally.
Exactly. And AI has so many layers and applications. And the way that we need to make our decision framework about what to do really needs to necessitate this idea of, is it the best use of our time to be building it? Is it something that we can actually acquire from a vendor that actually makes sense? So from a build perspective, we want to use AI in the build world where it's something that is so uniquely custom to our workforce, uniquely Boulder.
Bespoke to that.
Something exactly bespoke. I love that word. And then we want to buy the things that we don't need, but we have so many vendors right now are coming out with amazing solutions. And for me, one of the things that we were very focused on from the RCM perspective and the billing perspective, if we're going to be buying, the clear ROI needs to be there. And the clear ROI is going to be the story and the framework of how we think about the acquisition of different, not the acquisition, but the incorporation of different vendors in our overall ability to be more efficient.
And you can't do your core mission if you try to be everything to everybody.
Exactly.
This has been an awesome conversation. Thank you for joining me at the Finance Forward Summit, Mitzi.
Oh, well, thank you so much for having me, CJ.
Thanks. Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.